Good morning, ladies and gentlemen. This is Kulis 8, and this is the pre-market AM report for January 5th, 2015. Despite a horrific opening due to the Chinese market crash on Sunday night and the subsequent sell-off in global markets, spilled over into the U.S. Financial markets on Monday morning, focused, disciplined, and tactical Clueless 8 traders and investors landed in the green. Couple of very important things to keep in mind. Cognitive bias, which is the way we look at things in life and the way we look at trading, is an extremely intangible but critical factor in the determinant of whether or not somebody is going to be a successful trader or an unsuccessful investor or trader. All right, it's really as simple as that. I've said it and I'll keep on saying it, that this market is driven by algorithmic high frequency trading programs, what I call the rise of the machines. The individual investor is not in the game. I'm talking about the majority of them. Due to the extreme volatility generated by high frequency trading programs and caused by global imbalances and issues that we are quite familiar with by now, whether it be China, whether it be the drop in oil, whether it be tensions in the Middle East, whether it be Fed statements regarding asset bubbles or interest rate hike projections, things like that. The reality is that unless somebody is technically inclined and and whether somebody is if traders are not studying charts and every single tactical level that's posted out there from the Clueless 8 trading service via the real-time Twitter feed, end of the video casts, periscopes, the Clueless 8 YouTube channel, they will be lost. It's really as simple as that. I cannot stress the importance of the fact that this new normal of machine-driven trading is not for the old school. Like my favorite saying, this ain't your grandpa's market. So the bottom line is, I want everyone to read every single one of those mottos, what I call the Clueless 8 trading mottos that have been posted out there, and really practice them. Because I try to do that. Look, we all have our human failings. All right, we all do stupid things. We all get scared, and or we get too happy. Well, nobody ever gets too happy these days, that's for sure. I can say that about myself. And the reality of the thing is, but you have to act. This is my living. This I have to do every day, and I love doing it. And if that I and if that passion I can generate in my members, then I have no doubt in my mind that they will be successful. Trading, as I always say, is not a game of certainties. Neither is investing. It's a game of probabilities. And those probabilities are determined by how focused, how diligent, how hardworking, and how much time and energy you want to spend in learning the machine-driven market. And that for that sole reason, I keep on suggesting to people that they should sign up for the group advanced coaching sessions and really go through the intricacies of what I see and what has worked tremendously well, especially over the last couple of years, especially over the last year. And that's the knowledge that I share. And if members don't refuse not to do that, well, they should never complain, but basically look at themselves and tell themselves that they are a total failure. This is Clueless 8 Trading Bootcamp, guys, ladies and gentlemen. Okay? We don't pull punches here. I say it the way I see it. Saying all that, let's dive into the technicals and see what's going on. We had a tremendous day yesterday, and I believe that this week, I don't know what's going to happen to this week by the end of the week, but overall, I can at least make some pretty strong technical projections as to where I see the market going, hitting resistances, what the support levels are, and things of that sort. Keep in mind, It doesn't matter if you're a trader. It doesn't matter what trades stocks you trade, especially the high momentum beta ones that generate significant profits on an intraday basis or an intra-week basis. Keep in mind that it all happens within the context of this environment that you're seeing in the back, and that being the market. This being the E-mini futures in the background, the S&P 500 futures, and I'm going to walk people through it. Bottom line is, we seem to have a pretty significant um, support level here, and that support level on the futures or the of the S&P 800 S&P 500 index futures, the E-minis, is at around 1980. You can see that very clearly. Not rocket science. I'm going to keep this video cast very simple. All right. So pretty much this zone here. We lose this zone, we have some ways to fall. At that point, it's possible that we can lose 100 S&P points rather quickly over a matter of days, and that's roughly about 500 to 600, if not more, Dow points that we can lose. 1861, which was the pivotal low back after the May 24th flash crash. The next pivotal low was September 28th, September 29th. At some point, in my opinion, we're going to engage that. Will it happen right away? I don't know. Okay? Will it happen right away? I have no idea. All I know is that if we lose the support level, which has been a very powerful support level, it's a quadruple one if you look at it, or a quintuple one. 1, 2, 3, 4, and then 5. Then things get pretty hairy. The market is in a dangerous spot. The market never waves a green flag and says, buy me. For technical traders like us, yes, it does. Of these levels, we can project that the market most probably will get to 2020, which I said that before. That's roughly about 2025 or so on the S&P 500. And then at that point, either it pulls back, tests this 1980 or 2000 level, or it moves up from there. Pattern symmetry dictates from the bullish side that this move here, and there was a minor retest here overnight on the E-minis, just the way you're seeing it as I'm drawing it, that this pattern, this is really the bullish pattern, where we go back and test the 2040, 2045 level on the S&P 500. At that point, it hits major resistance on this red line here, the downtrend line, and either we break out or we fail. And then, rinse, repeat, and then keep on doing it. That's the bullish version. The bearish version would be that bear with me, let me get this. The bearish version would be that we have a failure at the 2020 level, or even here around these zones, and then we fall rapidly. We lose the 1980, and then things get pretty rough on the downside. I'm prepared for that. As tactical traders, we go long and short. So we don't particularly really care, despite the overall bullish bias on the trading side, we don't particularly care if we lose certain levels, what positions that we take. So at that, obviously at that point, the bias would be on the downside, and we would be involved in instruments which make money on the downside. UVXY, the SPX, SPY, RUT, IWM puts, things like that, right? So 1980 is the line in the sand, and we have to watch this carefully. We might slip and slide a little bit more, and possibly it could be a false breakdown, but we'll see what happens. So at this point in time, looking at this chart here, and I'm going to zoom in. My gut tells me that we're going to test this level here, okay, which was also the breakout level right there, back on back around the 20th of December, when Santa appeared with the vengeance and took the bears out big time, right there in the breakout, the big move. So we could, if pattern symmetry dictates, then we are going to basically do this, and that's called a trading range. Broke out a little bit, went down. If pattern symmetry dictates, then we are going to basically, the most we can get up to is around 2080. And that is the trading range, as you can see here, okay, between, let's say 2000 or 1980 and 2080. So 100 S&P points, 100 S&P points is the trading band that the market is following. So give or take, that's roughly about 5 to 600 Dow points. It's really as simple as that. Let's keep our mental calibration right. Read the mottos that's been posted out there, because I'll, those are things that I practice every day. I don't care how smart somebody is, how much they understand the all the uh, fundamentals and the balance sheets and the income statements and all that good stuff. The reality is, if you do not understand the new paradigm of algorithmic high frequency trading, you are finished. That's pretty much what it is. Okay, on a earnings note, we are coming into, in about a week's time or 2 weeks' time, we're going to be full blast into earnings season. That's going to be the next stage of the move, right? We have played earnings, ER plays, as I call them, many, many times. And my track record overall on calling the shots on the earnings has been pretty damn good. You can see that clearly of what we did in the last quarter, right? You don't need to go overboard. You can do small trades, and small can get large. And if you go the other side, small can get smaller. At least, you're not blown out of the water. Here's a chart of the S&P 500 that I'm showing you right now. And you can see the same juxtaposition. And one second, sorry about that. In what I explained to you on the E-minis, we have a hammer reversal. 1, 2, 3, a triple bottom here at the 1989 level on the S&P 500. Move up here would be around 2035. Max move 2048. There will be heavy resistance at that level. And if we break out, then we're going to get about 2080. If we break out over 2080, the next level that comes into play is 2104. Now keep in mind, we are still in the first week of January, despite yesterday's sell-off and the recovery and the nascent recovery that we're starting to see. And futures were pretty volatile overnight. You can see that on your own screens. We are starting to see, and this is a 4-hour chart, the closest thing to a daily that you can get. You see the crossover here, very simple, on the fast stochastics. You can use the slow stochastics too to see a more swing time frame. And at this point, if this crossover remains intact, despite the volatility that we'll incur today, we are going to be, go higher. At that point, we are going to get overbought up again in the 100 level, and by that time, we should fill this gap here at around 2038, if not around 2040. Those are pretty significant amounts of money, as you know. The S&P calls move point by point, and if you buy them in the money or close to the money, you get a significant bang for your buck. I don't need to tell you how many times S&P calls have gone from 6 to 40, and vice versa on the put side have gone to 6 to 40 also, depending on what your time frame was and whether you panicked or whether you sold too early. I'm just saying that's what it does. So if you get a move from the 1990 level, and I pinpointed the lows yesterday, up towards the 2040 level, you can basically get about 50 S&P points. Let's say you catch 30 of them. That's a significant number. Okay, as traders, you don't need to go out there and buy everything in the market. You need 1 or 2 amazing trades, a couple of great trades, and a few blow-ups, and you are still way ahead of the game. The last thing I'm going to say